Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. We continue our topics on intermediate accounting subject. This will be your last topic before the midterm, which is about investments. Yeah? So we'll basically discuss about debt investment and equity investment. Yeah? So previously, we were talking about dilutive securities, yeah, equities, yeah, from our perspective, people investing in our company. Yeah. In this topic, is our company investing in other companies? Yeah? That's why we call it as investment. So our investment in other entities, yeah, it could be in the form of debt, such as bond, debentures, yeah, or it could be in the form of equity. Yeah? So we become the shareholders of other company. Previously, we were accounting for other people's investment in our company. But now we are looking from an opposite perspective. We are investing in other companies. Yeah? We are buying other people's shares. We are buying, or we become the holder of the bonds issued by other companies or entities. Yeah, entities could be government bond. Yeah, the bond issued by the government. Okay. So we'll be discussing several accounting issues for the investments, especially the debt and equity investment. How to classify, how to measure. Yeah. And for equity investment, what if our ownership of other companies' share is less than 20%, and then if it is between 20 to 50%, or if it is majority ownership more than 50%, yeah, what kind of method that we can use to measure the investment and value the investment and disclose the investment in our financial statements. Yeah? And also, we have to talk about the issue of impairment as well for this investment. So, investments are basically classified as financial assets. Yeah? It's a part of financial assets. In previous topics, you have learned about cash and receivables. So, cash and receivables are as well the financial assets. Yeah? And now we learn another types of financial assets, which are the investment, like debt investment and equity investments. And why basically the company are interested to invest in other companies or entities? There are several reasons why do we want to invest in other people's company. Because normally the investment provides a high rate of return. Yeah? Our company's financial support cannot be only dependent on our main operational activity. Let's say if we are merchandising business, we cannot only depend on that merchandise business. We have to diversify. Yeah? Diperbagaikan. We diversify our financial portfolio. Yeah? That's why we have some investing activities. Yeah? We have the operational activities, which is our main activities of the company. So this is also the financial sources to support the operation of the company. Yeah? Because the investment normally provide a high rate of return. That's why the company is interested to invest in other company. Yeah? And sometimes there is a engagement, yeah, between different companies. Yeah? So that arrangement, the financial arrangement or operating arrangement, yeah, it could be supplying the goods to us. Yeah? There is contractual relationship between the two businesses. So that relationship or that arrangement can be secured by companies investing in the other company. Yeah? So it's further strengthened. Yeah? the operating or financing arrangement by us, let's say, buying the shares of that company, or we buy the bond of the company. Yeah. Okay, certain criteria need to be fulfilled when we want to classify and measure the financial asset. Yeah? So basically, the issue of financial instruments or financial assets within accounting standards is a very complex one. Yeah? The accounting standard from International Accounting Standard Board, which is the IFRS, yeah, has been amended from time to time, and it hasn't reached an absolute agreed accounting standard yet. Yeah? So IFRS 9 has been developed to treat the accounting issues for financial instruments, but it has been so much issues with the accounting standard because this is a complex issues, yeah, mainly involving with the fair value measurement, yeah? And IFRS has been very much inclined towards fair value, and certain countries, certain jurisdictions are not so much welcoming to the heavy focus on the fair value measurement. I think I've ever discussed with you what's the impact of using fair value measurement. Yeah? Certain effects are resulted from implementing fair value measurement, which are not sometimes favored by certain parties or people. Yeah? But there are, but IASB, International Accounting Standard Board, always believe that fair value measurement provides a more objective values of the company's financial assets. Yeah? Okay, going back into how we can classify and measure financial assets. First, we need to answer the following two criteria. Yeah? Whether the company's business model for managing its financial asset. Yeah? What is the company's business model in managing the financial asset? Does the business buys the financial asset for the purpose of trading it, or for the purpose of keeping it until the maturity period, let's say for the debt investment? Yeah? For equity investment, of course, you don't have any maturity date, but for debt investment, yes, you have maturity date. And what are the contractual cash flow characteristics of financial investment? So does it have a future specified date for us to receive certain cash flow? Yeah, let's say debt investment. We would receive interest payment over certain period. So those questions need to be asked. Yeah? How the company manage its financial asset? What is the purpose? Does it want to sell it immediately, or it want to hold it until the maturity, or it just wait for the capital, what do you call that? Market capitalization, yeah, let's say equity, you buy the equity, when you see the value has been increasing, then you want to sell it, yeah. So the classification and the measurement of those financial assets would depend very much on these two criteria, okay? Okay, in summary, how do we classify and how do we measure those financial assets? Let's say for the debt, for the first major category of investment, the debt investment, yeah? If it meets the business model of held for collection, yeah, and contractual cash flow test, means that debt investment is held until the maturity for the purpose of the collection later on, okay? So the bond, after we buy it, and then we will hold it until the maturity period to later on collect again our fund in that bond. Yeah? So that is held for collection. And the contractual cash flow test also give us the assurance that would receive certain cash flow payment in the period, throughout the period, until maturity. So in that context, that debt investment will be measured based on amortized cost. But let's say certain debt investment does not meet the business model test. Let's say the debt investment is held for trading. Held for trading means the bonds is purchased for the purpose of trading it. You don't wait until the maturity period. You want to trade it to get the profit. Or it is held for collection and selling. This is different from held for collection. Held for collection, we hold until the maturity for the purpose of collecting it later on. But held for collection and selling, it is not necessary that debt investment or bond, for example, will be held until the maturity. It could be sold before the maturity date. So that's why it is classified as held for collection and selling. So in that category, if the debt investment does not meet such business model test, so the measurement will be based on fair value. If you notice, the fair value measurement is used whenever the financial asset is supposed to be for the purpose of trading and selling, because it reflects the value better. Because you intend to sell it in the near future, you intend to trade it in the near future. You don't want to keep it until the maturity. So for the equity does not meet the contractual cash flow test. It doesn't have the fixed cash flow to be received in the future because it doesn't have any interest. The dividend is not sure that you would get it for the equity investment. So basically, equity is not within the criteria of meeting the contractual cash flow test, and also mostly it's not held for collection because it doesn't have any maturity date. So that's why equity must be measured at fair value. Except when for some equity investment for which the investor exercise some control, some control, let's say we own more than 50% of the shares of other company. So in that case, the equity method will be used. Later on, you will learn about what is equity method. Actually, you have been exposed during Principle of Accounting 2, maybe, about the equity method. Okay, let's look closely at the debt investment. Debt investment are basically characterized by contractual payments on specified dates of the principal amount as well as interest on the principal amount outstanding. As you understand about the bond. So we would receive contractual payment on the maturity, the principal amount, and every annually or semi-annually in each 6 months, depends on the terms and conditions of the bond, we would receive also the interest on the principal amount outstanding. It's a 6%, whatever percentage of interest of to be received out of that debt investment. So debt investment can be further classified into 3 categories based on what we discussed just now, the business model in managing the financial asset. So we can classify it as a held for collection and selling, and held for trading. Okay, held for collection, I mentioned to you, when we buy that bond, we want to hold it until maturity. Held for collection and selling, we buy it but we don't really intend to wait until the maturity date. We may sell before the maturity date, but trading is purposely you want to get from the fluctuation of the prices, market price of the bond. Yeah? So it's for trading purpose. Yeah? So how do we value for each category of debt investment? Held for collection, value at amortized cost, yeah, because it meets the criteria of business model, contractual cash flow as well. So when we value at amortized cost, we don't recognize any unrealized gain or loss. Unrealized gain or loss is only recognized when we use fair value, because we use fair value, we will compare fair value and our amortized cost, and the difference will become the unrealized gain or loss. Yeah? Other income that could be resulted from held for collection debt is interest when earned and gain and losses from the sale. Yeah? Okay, held for collection and selling, it has to be valued at fair value. Yeah? And any unrealized gain or loss from the valuation of fair value, yeah, will be recognized as other comprehensive income and as a separate component of equity. Yeah? Same other income attached to that debt category. Meanwhile, the trading securities also valued at fair value. But any unrealized gain or loss on trading equity will be recognized in net income, yeah, or in income statement. Yeah? So there is a difference here between the second category and the third. Unrealized gain for second category will be recognized in other comprehensive income, yeah, which will become a part of statement of changes in equity. But trading securities will be recognized in income statement. Yeah? The other income involved in these debt instruments are basically the same, yeah? Interest and gain and loss from the sale. Okay. Let's look the debt investment at amortized cost. For example, Robinson purchased 100,000 of 8% bond of Evermaster AG on January 1st, 2019 at a discount, paying blah, blah, blah. The bonds mature January 1st, 2024 and yield 10%. Yeah? Interest is payable each July 1st and January 1st. Yeah? So if you notice, when the bond can be classified as discounted bond, bond at premium, or bond at par. Yeah? The bond can be sold at premium, at discount, or at par. Yeah? When they say at discount, means the interest rate is lower than the yield rate. Yield could be regarded as the market interest rate. Yeah? And when it is sold at discount, means we are paying less than the par value of the bond. Yeah? If it is a premium bond, means we will we'll pay higher amount than the par, because the interest rate is higher than the yield rate. Means we'll receive more than what the market average interest rate can offer. Yeah? So let's say if the market yield is 10%, our interest rate is 15%, let's say. So that is premium bond. Yeah? In this case, it's discount bond. Yeah? Bond at discount. Okay, so on January 1st, 2019, when we purchase the bond, we would record the bond payable and the cash that we need to pay. Okay, so sorry, not bond payable. No, we are investing. Bond payable is when we issue the bond and other entity buys the bond from us. So this is our investment. So debit debt investment and credit cash. Yeah, we're paying cash for that amount. And for bond, I think you have to learn somewhere in financial management course that we have to prepare the amortization table for the bond, yeah, indicating the amortized cost, yeah, the interest revenue for each period, because it says that the interest is paid semi-annually, yeah, 1st July and 1st January. So 2 times a year. Yeah. So the first column is the date, and then the second column is cash received. Cash received is the interest based on the interest rate of that bond, which is 8%. Yeah. So 8% times the par value of the bond times 6 over 12 months. And then the interest revenue actually is the yield rate, yeah, the market interest rate. Okay. So 10% we times with the discounted value, yeah, and we times with the 6 over 12, yeah. And the difference between the two is basically bond discount amortization, yeah. And then we subtract the previous amount. Oh, we add, because it is a discount, yeah. So we add 90, let's say on the 1st July 2019, we'll add the previous amortized cost of the bond, which is 92,278. We add with 614, the bond discount amortization. So we get 92,892. Okay, so that goes until the maturity date, yeah, in the year 2024. Okay, when the company received the first semi-annual interest payment on July 1st, 2019, it would record as a cash 4,000. And then the bond discount amortization we debit, okay? We debit debt investment, and then we credit interest revenue, okay? Okay, despite that the payment is on the 1st of January and the 1st of July, when we close the accounting period on 31st December 2019, we need to record the accrued interest, okay? The accrued interest on the December 31st, 2019. So we debit interest receivable 4,000 and we credit interest revenue 4,645 and debit debt investment 645. Okay, so how it is disclosed on the financial statement? Basically, on statement of financial position, it will be disclosed the debt investment as well as the interest receivable, the accrued interest just now, because we haven't received it on 31st December 2019. And on the income statement, the interest revenue needs to be recorded. Okay, what if the company wants to sell that bond on November 1st, 2021, yeah, before the maturity date? Let's say at 99% 3/4 plus the accrued interest. So we need to calculate the accrued interest or the discount amortization. The payment is on 1st January and 1st July, right? So from 1st July 2021 until November 2021, July, August, September, July, August, September, November. So we have 4 months accrued interest that we need to account for discount amortization. So we take that 783, the total bond discount amortization, and we times it 4/6 months, yeah, to calculate the interest revenue for that period. So it gives us 522. So now we compare the selling price of the bond compared to the amortized cost of the bond. Yeah? So the selling price is 99, blah, blah, blah. And then we identify the amortized cost based on amortization table schedule, yeah, on July 1st, 2021. It is 95,671. And then we add with the discount amortization for the 4 months just now, the accrued interest. Yeah? So we get the selling price is higher than the amortized cost as per November 1st, 2021. So there is a gain on sale of bonds of 3557. So how do we record? Because it says exclusive of accrued interest. So basically we'll receive the selling price of the bond plus the interest on the bond. Yeah, so we receive cash 99,750 is for the selling price, 2,667 is the interest. Yeah, and we get from the 4,000 interest revenue for the 6 months, but we need to calculate for the 4 months. So 4/6, we get the interest revenue of 2,667. And we'll close down the debt investment account of 96,193. Yeah. And if there is any difference on the credit side, it will be gain on sale of investment. Yeah. Means the cash that we receive from the sales transaction is more than what the amortized cost on our amortization schedule of the debt investment itself. So we get the gain on sale of investment. Yeah? So let's say if the debt investment and interest revenue is higher than the selling price that we get, plus the interest in this case, so we'll get the loss on sale of investment. So this is like the disposal of fixed asset, similar case. Okay, now we move to the second category of that debt investment, held for collection and selling. Just now it was held for collection only. Now it's held for collection and selling, the second category of debt investment. Yeah? Basically, the same accounting entries applies to this classification, that they are recorded at amortized cost, but at each reporting date, which means at the end of the accounting period, the companies needs to adjust the amortized cost to fair value. And the adjustment on amortized cost to fair value will result in unrealized gain or loss on the fair value adjustment. And that unrealized gain or loss will be reported in other comprehensive income, not in the income statement. Unrealized holding gain or loss reported on income statement will be for the third category of debt investment, which is held for trading. Yeah? Okay, let's say in this example, the company purchased 100,000, 10% 5-year bonds on January 1st, 2019. Interest payable on July 1st and January 1st. The bond sales for 108,111 result in bond premium. Okay, this is the opposite case from just now. Just now it was bond sold at discount. This one is bond sale at premium. Yeah? Effective interest rate of 8%. Okay. So the interest rate that we receive is higher than the yield itself. Yeah? The interest rate that we receive is 10%, the yield is 8%, or the effective interest rate. Yeah? So to record this premium bond, we debit debt investment 108,111, and we credit cash 108,111. Okay. So if you notice the difference between the premium bond and the discounted bond, in the premium bond, the cash received is more than the interest revenue. Okay, so we have the bond premium amortization that has to be reduced from the amortized cost to get the carrying amount of bond. Yeah, so in here previously we add in the discount bond, but for premium bond in this case we minus it or we deduct it. Okay, how do we record interest revenue? Basically, we debit cash and we credit debt investment, and we credit interest revenue. Yeah, if it is discounted bond, we debit cash, we debit debt investment, and we credit interest revenue. But in premium bond, we credit the debt investment. Okay, so it will reduce the value of debt investment. Okay, we have to accrue the interest on the end of the accounting period, despite that the interest has not been paid until 1st January of next year. So to record the accrued interest, debit interest receivable and credit debt investment and credit interest revenue. Okay, as we mentioned just now, that for held for collection and selling debt investment, we need to adjust for fair value at the end of the accounting period. Yeah, so we need to compare the carrying amount of bond or the amortized cost of the bond from the amortization schedule with the fair value of the bond on that date. Yeah. So in this example, let's say the fair value of the bond is 105,000. Yeah. Meanwhile, our amortized cost is 106,732. So fair value is lower than the carrying value. Okay. That means we have to adjust the fair value, right? We need to record the new value of 105,000. Means there is a reduction to the debt investment. It's a loss actually, okay, because the fair value is less than the carrying value. So we need to debit unrealized holding gain or loss because this is loss, so we debit it, and we credit the debt, the fair value adjustment. Sorry, we don't credit the debt investment account. That is the case of held for trading debt investment later on, yeah, where we will credit straightly to the debt investment account. But for held for collection and selling, we have an account named fair value adjustment. Okay. 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 Let's say portfolio of securities means the company could have more than one type of securities or financial asset. Yeah. It could have the debt which is held for collection. It could have the debt which held for collection and selling. Yeah. So it will show here. Let's say under held for collection and selling, also it has several types of debt investment. Yeah. Say they have the bond from Watson 8% and then Anacom Group 10%. Yeah. So they would display how much the amortized cost and how much the fair value and show how much the unrealized gain or loss. Yeah. And then the net amount of fair value adjustment. Okay. If it is loss, is indicated with a bracket here. Yeah. So there is a net loss of fair value adjustment or unrealized loss on fair value adjustment. Yeah. Okay, to record the loss, basically debit unrealized holding gain or loss, and we credit fair value adjustment. Okay, what if the company sell the held for collection and selling securities before the maturity date? Yeah? So it's always the case that if we sell the fixed asset, if we sell the investment or the financial asset, we need to close down all related accounts to that asset. Yeah? If it is debt investment account, how to close it? Then we need to credit the debt investment account and other related accounts to that debt investment, right? Okay. Unlike the fair value adjustment just now that we record on comprehensive income, yeah, the unrealized gain or loss. But the sale of this debt investment needs to be recorded in income statement. Yeah. So during the period, the fair value adjustment need to be part of statement of comprehensive income or other comprehensive income or loss, which is part of equity. But when we sell it, any realized gain or loss on the sale, now it needs to be included in other income and expense in the income statement. Okay, I know it's quite a bit confusing for you to remember, but because we want to dispose this investment asset, that's why we have to close down everything, and then we need to transfer or recognize any gain or loss to the income statement. It's no longer in the comprehensive income. Comprehensive income is only for the unrealized gain or loss on the fair value adjustment. Okay, let's say the company sell the Watson bonds on July 1st, 2020 for 90,000. And the amortized cost at that time is 94,214. So the amortized cost is more than the selling price, means we get the loss on the sale of the bond of 4,214. Okay, so we debit cash 90,000, we debit loss on sale of investment, and we credit debt investments at the amortized cost, to close down that investment account. Okay, this realized loss just now, 4,000 something, will be reported in other income and expense section on the income statement. Yeah, it's no longer on the unrealized comprehensive income. Yeah. So the fair value adjustment now is has been reduced to only coming from one type of the bond. Yeah? The Watson bond is no longer in this disclosure. It's no longer in unrealized gain or loss measurement. Yeah. Okay. Okay, so the fair value adjustment only now coming from another group of bond. Yeah. So we record that fair value adjustment only for 4,537 and unrealized gain or loss on equity. So how it will be disclosed on financial statement? Yeah, the debt investment on the statement financial position, and if it has any interest receivable, yeah, on the equity, if there is accumulated other comprehensive loss. And then on the income statement, we will record the loss on sale of investment just now of 4,214. Yeah. Okay, last category of debt investment is the held for trading investment, yeah, or trading investment. Okay, for trading investment, as we mentioned just now, it must be reported at fair value. And unrealized holding gain and loss record as part as net income or in the income statement. I hope you can remember the difference between the trading investment and the held for collection and selling debt investment just now. Because held for collection and selling debt investment reported at fair value, adjusted to fair value at the end of accounting period, and any unrealized holding gain and loss will be reported in other comprehensive income or loss, yeah, in the equity. But for trading investment, any unrealized gain or loss reported in the income statement, yeah, as other income or loss. Yeah. Okay, so basically holding gain or loss is a net change in the fair value from one period to another period. Yeah, it's not included in there the dividend or interest revenue that is accrued but not received. Yeah, it is separately disclosed. Okay. Okay, so this is the example of trading debt security portfolio of this company. So it has several bonds portfolio here that are for trading purposes. Yeah, and it will have the fair value adjustment for each type of the investment itself, or the bond, in this case. Yeah? So the same principle applies. We will record the fair value adjustment, okay, and unrealized holding gain or loss. In this case, it is actually a gain because it's credit. Yeah, if you see on the statement, it is positive, it's not in the bracket. So it is unrealized holding gain or loss. But it will be reported in the income statement, yeah, not in the other comprehensive income, comprehensive income or loss. Yeah. Okay, what if the company, despite that they have held for collection debt investment, but they choose to report them on the fair value, not based on amortized cost. Yeah? The IFRS basically allows the fair value option, when the company can have the option to report their financial assets at fair value. And gain and losses resulted from the change in fair value is reported in the income statement, but it must be applied on an instrument by instrument basis. Yeah? So it cannot be based on the whole portfolio. It has to be by the instrument individually. Okay, instrument the bond A, bond B must be separated. Okay, cannot be lump sum. Okay, so when they decide to value their debt investment at fair value, they must measure this instrument at fair value until the company no longer has the ownership, or until they sell it, yeah, or they transfer it to other entities. Okay? Let's say for this example, the company purchased bond issued by the German Central Bank, and the company plans to hold the debt investment until it matures. Yeah, if we see this statement, this debt investment shall be classified in held for collection. Yeah? But the company choose the fair value option to account for this investment. Yeah? So on the date of the purchase, or on the date of investing, as usual with debit debt investment, and we credit. Okay, because they choose to value it at fair value. So on the first time itself, it has to be recorded at fair value, and any adjustment needs to be accounted properly. Okay. So the amortized cost of the investment is 100,000. Meanwhile, the fair value is 113. So we need to recognize the unrealized holding gain or loss. In this case, it's a gain actually. Okay, because the fair value is higher than the amortized cost. Okay, for this case, when the company choose the fair value option, even though it is held for collection debt investment, then it doesn't use any fair value adjustment account. But any adjustment to the fair value, it has to be recorded straightly to the debt investment account. Yeah? Okay, so unrealized holding gain or loss will be part of income statement, and then they will reduce the value of the debt investment itself. Yeah, if it is the fair value is less than the amortized cost. Okay, I think I'll stop at that, and we'll continue another part of the topic, which is equity investment, in the next discussion. Okay, thank you and all the best. Assalamualaikum warahmatullahi wabarakatuh.